Hi, I'm Lary Wolf. This is Stuart Gross. We're partners at the law firm of Roberts and Holland, and we're going to be talking about the limitation on interest deductions that was put into the new tax law. This is potentially a big deal for real estate, but as we'll see, real estate got another one of those good benefits that don't apply to many other kinds of businesses. So under the old law, business interest was generally deductible. Under the new law, the deduction for business interest is limited, and you can't deduct it to the extent that it is greater than the business interest income plus 30% of adjusted taxable income. So business interest is what you think of, interest on indebtedness allocable to a trade or business. Business interest income is interest income allocable to the trade or business. So if you're in a lending business, you're going to have business interest. It does not include investment interest, only interest received in connection with a trade or business.
And so interest that I earn on my cash balances and operating capital and things of that nature, that's not business interest income. Is that investment income?
That's one of the questions, Stuart, we're going to need a little guidance on. And hopefully we'll get that sooner rather than later. And guidance from the IRS can take one of several forms. Regulations are binding on the Internal Revenue Service. They take the longest time to get out to the public. The IRS has the ability to issue revenue rulings or notices explaining how these rules work. That can be done much more quickly, and in fact, the IRS has already issued several notices, mostly in the foreign area, helping taxpayers figure out what's going on under the new law. So Stuart, your questions, as always, are good questions. Trade or business, for this purpose, excludes performing services as an employee. And then there's an exclusion for any electing real property trade or business. And that includes activities in development, construction, acquisition, leasing, and management. This is big for real estate. You can elect out of the interest limitation, and you won't be subject to this 30% of adjusted taxable income limit. There's a consequence to that, which we will talk about. So adjusted taxable income from 2018 to 2022, you look at your business income and you add back in depreciation and amortization. After 2022, it's your income taking into account depreciation, which is usually a much lower number. So that limitation can have a significant impact on businesses that borrow. Often, real estate owners borrow more than 30% of what would be their taxable income. So real estate got a big bonus. There's also an exception to these rules as a general matter. If a gross receipts test is met, then you don't apply the interest limitation. And to come within this rule, the average gross receipts over a 3-year period can't exceed $25 million. And there are very complicated related party rules to determine how you determine gross receipts and what businesses you add together to find out if you have $25 million of gross receipts.
Certainly commonly controlled businesses and commonly owned businesses are going to be aggregated for purposes of that $25 million test.
That's correct. So this is an important new rule that real estate owners have a benefit, and in a later segment we'll talk about potential negative consequences of electing out of the interest limitation rules.
Is the election, Larry, is it on a property by property basis? Is it on an entity by entity basis? Is it on a trade or business by trade or business basis? Do we have any guidance as to how that applies?
We really don't have guidance on to how this is going to apply.
the consequences of electing not to be subject to the limitation on deductibility of interest is that you are not eligible for more favorable cost recovery rules that are part of the new legislation. Probably most significantly, the 100% bonus depreciation that's part of the new legislation is not able to be taken advantage of if you elect out from being subject to the interest limitation. There are other differences as well relating to depreciable life and things of that nature, but the differences relate to the ability to claim depreciation deductions or even 100% bonus depreciation.